UiPath is trading at $20.09, and it is down over 76% from its all-time high of around $85 in May of 2021. So the question people are asking is this a good time to buy? Should you buy the dip? Now, the good is they have beat their last 4 earnings calls by an average of 164%, which is a display of insane growth. They also just increased their revenue projections on top of that. Their debt to equity is 0.03, which is good. And again, historical growth rate is really good in terms of revenue and now net income, now that they've trended in the positive for the first quarter. And using a price to earnings analysis, a lot of the data I found online was conflicting, so I had to pull up their actual quarterly reports. And in doing so, I found that they posted an EPS of 6 cents for the first quarter of this year. And if we extrapolate that into a yearly EPS based on their current growth rate of around 183% per quarter, then we can expect an EPS of around 28 cents this year. And now, obviously, that is unrealistically high and definitely not attainable for long, but given how low the EPS is currently, I think that they can at least hold on to that for maybe a year. And if we take their current price of $28.09 and their EPS of 0.28, that makes a PE ratio of 71. And again, that valuation is incredibly high. But given that they've beat their last 4 earnings estimates, I think it's pretty safe to assume that they're going to continue beating them in the future, but maybe not by as much of a margin as they have been. So if we assume they're going to beat their next few estimates by, let's say, 20%, then that would push their 2024 projected EPS to about 0.33, which is a PE of 61. So a little better, but still pretty high given that we arrived to that number using some pretty crazy growth estimates, again, of 183% growth per quarter for the next 4 quarters. And that said, though, the average technology sector PE is 45.1. And even if we assume a growth rate of, let's say, 40% per quarter, then that would make our annual growth rate 167%, which I think is a little more realistic. And that would give us a PE ratio of 45 of around the 2025 to 2026 mark based on the current price, meaning there's about 1 or 2 years worth of 160 cent per annum growth built into the stock, which is pretty insane. So it's looking a little on the overvalued side from a price to earnings standpoint. But if we use a price to sales multiple analysis, the revenue is projected to be around $2.1 billion by 2027, which multiplied by their current price of sales would be a share price of around $32.83, which is a 62% increase from today. And their valuation is just slightly lower compared to the industry average. So if we use the industry average forward price of sales of 10.39, then we would get a share price of around $37 by 2027, which is an 83% upside. So it looks like, overall from an earnings standpoint, there's a lot of growth built into the stock already, but in terms of price to sales, it seems pretty reasonable. And personally, I would like to see these estimates be a little closer for me to pick up shares, but people are expecting a lot of growth from this company going forward. And so what it really all comes down to is if you think they're going to continue beating those earnings calls and you don't mind a bit of valuation risk on the earnings side, then it might not be a bad play. But if you don't like volatility, you don't like risk, then this is definitely not the stock for you. So please drop a like. And if you have any thoughts, feel free to comment them below. And as always, thank you for watching, and I will see you next video.